You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. I hope that you've been well. So how can I ensure I have income in retirement? That is going to be today's topic. Policies built for infinite banking or whole life policies can be accessed for income in retirement, and I'm sure that's one of the reasons you and many people are interested in this strategy. The fact that you can access your funds in retirement income tax free is a huge draw, let's be honest. But another vehicle that you could set up for yourself that would create a guaranteed lifetime income would be an annuity. I love these vehicles also because they guarantee you will never run out of income, even if you run out of money. So I've mentioned annuities before in previous episodes. I just had a reason to bring it up again. Well, every situation is different, but one thing is for sure, you will need a regular income stream or monthly cash flow every single month until you leave this earth, because how else would you pay for your bills, your monthly bills, your mortgage, your rent, your car payment, your food? You're going to need that regular cash flow. So annuities are something that I share with clients when they are a good fit and when it makes sense as an option for them. However, I read something recently that really highlighted the value of these contracts, especially now. There is a man who is well known in my industry for helping people with life insurance. He is not an IBC practitioner, nor does he specialize in teaching IBC in any way, but he simply loves the industry of life insurance. Well, this gentleman put out a newsletter recently for life insurance agents where he was reminding us of just how bad of shape we are in this country when it comes to the deficit. With our deficit now over $37 trillion, the future of taxation looks bleak. It is forecast that by 2029, we will be at $47 trillion in debt, and that by 2033, $57 trillion. That is totally horrific. And this forecast was made before the big beautiful bill was passed. That would tack on another $3 trillion to the years 2029 and 2033. So whether or not the numbers play out in this forecasted way and the deficit increases just as projected, because of course we are yet to see what's going to happen, this is still not a good forecast just in general. When talking about the deficit, sometimes people ask me, well, why can't we just eliminate it? I mean, don't we owe it to ourselves? Why do we have to pay it? Can't we just eliminate it? Well, that wouldn't work out too well, actually, because we owe it not only to domestic investors, but also countries like Japan, China, the United Kingdom. So we can't just say, sorry, we're not going to pay you back. That would not work out too well. Another scary thing is that by 2033, 72% of our gross national product, which measures the total value of goods and services produced by our country's residents and businesses, will go to federal, state, and local taxes. It is quite clear that our government debt is increasing at a super fast rate, and because of this, they will have to do whatever they can to reduce interest rates. Who knows how long they will maintain current rates, but it only makes sense that they would have to reduce them in future years because our country simply can't afford the interest on our own debt. At the rate we're going, we will soon not be able to even afford the interest on the debt, just the interest. That's pretty scary. So the reason this is so important and why I wanted to do an episode on this topic is because when interest rates come down, insurance companies will eventually reprice their products. Certain products that are available right now are priced and based on current interest rates. However, as rates start to come down, if or when they do, because otherwise we can't afford the interest on our own debt as a nation, then that will get priced into products issued by life insurance companies. This goes for annuities and whole life and other financial products. For example, a few years back, insurance companies launched a new whole life product that had a lower guaranteed crediting rate than the product that they were discontinuing. So they're issuing a new product, they had lower guarantees than what we'd already been helping people with to that time. So the reason they lowered it is because they were basing their new product on the lower interest rate environment that we were in for a very long time. But just after they made this change, well, interest rates started rising again. But they haven't jumped back and suddenly changed the interest rates and increased them on current life insurance products or some parts of life insurance products, whole life, because they are slow to react. Now, when that happened, people were concerned at the time because they thought that that drop in that guaranteed crediting rate would be a dramatic difference. Though, luckily, due to changes that also happened in the mortality charges, it actually evened out pretty well. But what I wanted to point out is that even though insurance companies may take a while to roll out a new product based on previous rates, we still don't know when that's going to happen. So I'm not sure if rates will go up again since we've been in a higher interest rate environment for a while, if they will stay as is, or if they will start to decrease once the interest rates do eventually come down. But the point I'm trying to make really is that annuities are priced well right now. They have higher guaranteed rates than they've had in a very long time, and they have good distribution rates. Now you might be wondering, what is a distribution rate? So I'll explain it to you. A distribution rate on an annuity contract is the rate at which they will pay you on your lump sum of money. Now, there are guarantees and cool features to help grow that lump sum with certain types of annuities. And so long as you will be taking the funds as an income stream one day, rather than just pulling out chunks of money or transferring the whole account. And it's different with different companies what those features look like. But let's just talk about the distribution rate for now. Let me go over an example. Let's just say you have 500,000 in your annuity. Maybe you rolled it from a 401k or an IRA or other investment account, or maybe you just had the funds in cash and decided to begin an annuity contract. And now let's say that you're retiring and ready to start pulling a monthly income stream from this account because you need the monthly cash flow that you can count on every single month. So let's say you're age 67 when you decide to begin this process and start pulling money from your annuities so that you can have that cash flow every month. And the distribution rate at that age in this example is 5.5%. So what that means is they are willing to pay you 5.5% of your 500,000 each and every year for the rest of your life. And you can have that paid monthly. You don't have to have it paid on an annual basis, but that is a percentage they are willing to distribute to you each year on your lump sum. So you basically take the 500,000, multiply it by 5.5%, and that's the number. That's your income number. Now that distribution rate goes up as you age. And that 5.5% that I used in this example is just that. It's an example. Different factors affect your distribution rate. There are also options to cover your spouse's life, for example. And so that means that you'd be guaranteed to receive an income stream through both you and your spouse's life. That distribution rate will be different depending on your age when you begin the income stream and also your spouse's age when you begin. If the account will be paying through two lives, then the distribution rate will be lower. But one thing that I find really cool is that so far these contracts have paid at a much more decent rate than the general advice of the investment industry. They used to say that you could safely take 5% of your lump sum of assets from your investment account to live on in your retirement years so that you're careful not to spend down the value and run out of money. However, in recent years, that distribution rate suggestion from the investment industry has gone from 5% to 4% to down to 3%. And still, there is the general up and down market risk that could advance the losses in your account while you're drawing it down so that you may have to withdraw less in some future year to preserve your funds so you don't run out of money. But with an annuity product, Designed for income, that rate is guaranteed for the rest of your life and your spouse's, even if your account runs out of money. This is the same type of product that works like a pension. So you are essentially creating your own personal pension. Of course, there are other versions of annuities as well. There's different types that I would be happy to explain. This one that I'm talking about today is the type that is a great option for providing lifetime income for both you and your spouse that's going to be there for sure on a guaranteed basis. One other win with this particular product that I have in mind is that your income stream would double if you were to trigger a long term care need. Now, this isn't with every company. This is a specific company that I'm thinking of. And it's just something that I think is so cool because the cost for long term care can be so astronomical that every little thing you can have in place to help you in that time period in case you do have a long term care need would be very, very valuable. So, this particular product will give you that lifetime income stream when you're ready to begin. And then, if you have a long term care need, if you're able to trigger that extra benefit, which means you are unable to perform 2 out of the 6 activities of daily living, then your lifetime income that they're paying you every single year, or if you have it paying monthly, would double while you are dealing with that long term care need. Now it would double until your account gets drained down to $0. Because keep in mind that as you're receiving this lifetime income, of course, it's drawing down your account value. So now if they double it because you have a long-term care need, well, it's going to draw your account down faster. But at least you have that little boost at a time when you may really need it because we don't know what your lifespan's going to be. Who knows how long you're going to need that care, but at least it's something that can help you for a while up until your account value goes to 0. And once that was to happen, then your income stream would go right back down to the same level that it was when you started it. So it doesn't go away once your cash in your account goes to 0. It just lowers back down to the original income payment that it was sending you. So I have a particular product in mind that I'm thinking of, and there may be other companies with a similar feature, although when I checked before, there really wasn't very many, maybe one other company that I found at the time. And also, sometimes states don't allow these extra features. So, California is always a difficult state. They, as of the last time I checked, did not offer the feature where it would double if you had a long term care need. So, that might be something that works in your state, or it might not be because of your state rules. Now, as I mentioned earlier, with the interest rates most likely coming down in our future and maybe the not so distant future, these guarantees will come down with it. Not only will the guaranteed features within these products be lower and the fixed rate options go lower, the distribution rates can also be lower. So, after reading this in that newsletter last week, I thought it was important enough to share that now is a good time to lock in at current rates. If you happen to have a scenario where you think this might be a good fit for you, I thought I would bring it up that there's such a thing out there where you can create something like your own personal pension, and rates are pretty decent right now, and we don't know the direction they're headed. That's really it. I just wanted to point this out in case it would be helpful to someone. So, if you heard today's podcast and feel like this is something you would like to incorporate into your financial plan, or maybe you would like to learn more about it to see if it's a good fit for you and might make sense with what you're already doing, what you already got going on, and if you would like to work with me as your advisor, feel free to reach out to me at valerie@alphaomegawealth.com. I would be happy to take a look at your whole financial picture, help you further with protecting your assets, help you incorporate vehicles with guarantees in place, and of course, help you implement the infinite banking concept if you're feeling ready to proceed with creating your own family banking system. I hope you enjoyed today's episode, and I hope you have a great week.